Jim, one of the mega trends on Wall Street has been tremendous growth in socially responsible investing. The pros call it ESG, for environmental, social, governance factors that they look at when evaluating an investment. There is now $17 trillion of managed money that looks at these kind of social factors, and that's about a third of all the money in mutual funds and other investment vehicles. But the Trump Labor Department has tried to put the brakes on this growth. They've issued a rule that if you want to put an ESG type fund in a 401k or other retirement plan, you've got to show that it's that you're making those decisions for financial reasons and not for social ones.
And that's going to cause a bit of a problem, because for the last 2 years or so, ESG funds have done very well. They've beaten the S&P 500. You look back 10 years and not so well. Some of them have underperformed. Generally, in fact.
Well, the evidence is mixed, and there are a couple of theories on that. I mean, one is that the ESG funds are, when everybody crowds into an asset, you drive up the price, so the expected return is going to be less. The reason they've outperformed in the short run is because basically the oil and gas industry has collapsed, and most of these funds, these environmentally conscious funds, avoid fossil fuel companies. But the collapse is because of the short-term collapse is because of COVID, and remains to be seen whether those stocks come back or not.
Oh, sure. And if you're not investing in a whole lot of other companies, that blow carbon up into the air, make bombs and planes that kill people and nasty things like that, then you're going to have to invest in a lot of technology companies.
Right.
And those have done very well during the pandemic. So it's just kind of luck over the pandemic that they've done so well.
Yeah, exactly. I mean, they make these bets, but when you narrow your, investment theory would say when you narrow your investment set, you're going to increase your risk of versus of underperforming versus a broad index fund. And the other problem is there are dozens of different there's a different definition for every investor almost of what is a socially responsible company. One study looked at about 70 different ratings companies and found vast differences. Someone would rate a company up here and another one would put the same company down here. They one company might one index might look at whether heavily weight the environmental factors. Another one might heavily weight whether they provide benefits for gay spouses. Another one might place the most emphasis on governance factors such as women and minorities on the board, or
there have been some studies, a lot of studies, like 2,000 studies have been done as to whether a company, an individual company that follows these guidelines does better. And generally, the evidence is mixed, but generally they tend to think that a company that follows ESG guidelines does perform a bit better than companies that just ignore them. And that makes sense. In some ways, you have, for instance, it requires an independent board, that's not under the chairman's thumb or the CEO's thumb. It requires that you pay some attention to pollution, which can come back and bite you in the long term if you don't. Requires that we have, fairly decent labor relations, so you're not having massive turnover among your.
That's the argument that fans of ESG, put forward. They say, well, the companies we invest in aren't going to get hit with those big environmental lawsuits or this big, discrimination suits by employees. But the counter argument to that is, hey, the market knows this stuff and it's priced into the price of the stock. So, you might be getting good companies, but you're paying a lot for them. So your expected returns, may indeed be less.
Now, if I were running a 401k plan and I said, well, I want to include an ESG fund,
Yeah.
my motivation might be that my employees want it.
Exactly.
These are basically feel-good funds. If I can feel that I'm, investing in the ESG fund, I'm not going to, buy a defense contractor. I'm not going to be investing in nuclear plants. I'm not going to be investing in, steel plants that are blowing carbon up. I'm going to feel good about myself.
Exactly, and there is a lot of demand from
Yeah.
investors. As I said, almost a third of all managed money is following some version of these guidelines, and Wall Street loves it. The head of BlackRock, one of the biggest investment management companies, said a few months ago that kind of environmentally conscious investing would bring about a fundamental reshaping of finance. That would become the norm. That investors would look to companies that had sustainable business plans.
And his position was that the companies that follow these guidelines tend to do better. That was his argument.
Yes.
I don't know, but in terms of a feel-good fund, I'm not really sure that they have any effect. Does it make a difference to Boeing that these funds will invest in them simply because they're they make warplanes? I mean,
there has been some effect on the some research on the governance side. For instance, about 4 or 5 years ago, a lot of the big money managers started voting against directors if a company didn't have women on its board. And lo and behold, now almost 90%, I think, of the S&P 500 have at least one woman on the board. Companies do react to pressure from their investors.
Well, not only that, but the exchanges are reacting to it. NASDAQ, for instance, is going to require diversity on boards of directors. Yeah. And you can get arguments back and forth as to whether there's a financial gain from that. Would companies be better off saying we want the best people who understand the business and the financing, and we don't care what race or gender they are?
That is the traditional. That is the traditional argument. But on the other hand, there are certainly a lot of qualified women and minorities, and if the sort of the good old boys network was overlooking them, then maybe the company that grabs those smart people, puts them on the board, will have a comparative advantage. But back to the Labor Department rule. Yeah. This is late in the Trump administration, obviously.
Yeah.
I would not be surprised if the Biden Labor Department rethinks this and goes a different direction.
Yes, as well as with 1,000 other things that the Trump administration is
doing. And as I said, Wall Street would be quite happy with that. Something like 95% of the comments on this rule were against the Trump administration's approach, and most of those comments came from big money management firms.
So something tells me if the big money management firms and the liberals in the new Biden administration are on the same team, that's what's going to be done.
Yeah.